Okay, so you're ready to invest in the stock market, and you've heard many of the stock gurus like Warren Buffett say, be sure to analyze that stock very well before investing in it.
A stock is part of a business. You value a business, and then you divide by the shares outstanding. What you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol.
Now the question becomes, how do you properly analyze a stock, and how do you do it in a way where you actually ensure that you're making a good investment in the first place? Well, in this video, I'm gonna walk you through the process of analyzing a stock effectively, and this is not from my perspective, but how the best investors in the world do it. So first things first, you really need to understand the business that you're analyzing, and there's no better way to do this than to read the company's annual report. Here what you're looking for is what is the business model for that particular company. In other words, how is the company making money right now? This is often found in the first sections of the company's annual report, and if you can visualize this information by using a diagram like this makes it so much easier for you to understand and use this information in future parts of the video. Now the second thing that you need to analyze before you invest in a company is the company's risk factors. This is also included in the company's annual report, and it's very important to know this because in order for you to invest in a company, you need to realize that there's risk involved in that activity. And it's very important for you to know what those potential risks are so that you feel comfortable with the decision that you're making. For a good company, ideally, you want the risks to be more external than internal, because that means that the company is taking care of the things that it needs to take care of. And if the risks are mostly external, this is natural because there's not much that the company can do. However, one thing to remember is that those external risks cannot be so bad and so likely to happen that are gonna take the company down. Next up, you need to analyze the company's competition, and this is something that we already talked about before in the previous video for the value investing series. But one of the main things that you need to know about the company you're analyzing is what are the products and services that it's offering and how do they compare to the competition. For this, I highly recommend that you look at a competitor matrix like this that is gonna make the answer to this question a lot more clear. Believe it or not, another really valuable thing to do is to look on Reddit and type in, for example, Apple versus Microsoft and compare specific product, and you will get very honest feedback into what people on Reddit think about that particular product that the company's offering and how it differs from the competition. The next step to analyze for a company is the company's management team. And this is critical because if the company has everything right, but the company's management team is bad, then no matter how good the market is, no matter how good the product is, they're not gonna make the right decisions that are gonna lead the company to do better and your investment to take off. So here are the things that I recommend that you look at when it comes to analyzing a company's management team. The first thing that I recommend that you look at is interviews of the company's top management team. So you can go on YouTube and type in the name of the CEO, the CFO, and see if there are any interviews that you can look out there that are gonna tell you more about who these people are, what their values are, and what is the mission that they're leading the company on. After you look into this, another thing that is really powerful is to go on Glassdoor and type in the name of the company's CEO, and you can see the reviews and the comments that the employees are leaving and what they're saying about that particular manager of the company. Of course, what you're looking for are positive comments that the employees are leaving about the company and positive comments about the leadership style of that particular manager of the company. The next step when it comes to analyzing a company is to look at the actual market itself. This is something that we already talked about on the previous video, but you can check out that video so you can get more more details on this specific step. In here, just make sure that you look at companies' market reports so that you see how big is the market, how big is the current concentration of that market captured by that particular company, as well as the expected growth of that market. The last step to look at in order to analyze a company successfully is to look at the company's financial statements. Here, what you're looking for is to make sure that the company is financially stable and that it's heading in the right direction. So of course, making sure that the revenue is going and that the profit is growing along with the revenue. Looking at the balance sheet and making sure that the company has enough cash as well as current assets that it can use to cover the current liabilities, and making sure that the company doesn't have a lot of debt that it can't pay off. You also want to look at and make sure that the company is growing the shareholders' equity over time, as this is basically the type of ownership that you would have. And the last thing to look at is the cash flow statement. Generally, the best thing to look at in terms of the cash flow statement is the free cash flow. So what you want to see is a company that is constantly growing its free cash flow over time and that is investing its money wisely and generating a return in terms of free cash flow as well as the net income of the company. The last thing that you want to do is to value the company. So after you do your research, you're going to have a much better understanding of where the company is headed and where the company is likely to go and how it is likely to perform financially in the future. So your job as an investor is to use that information and use a valuation method that you feel comfortable and that it makes sense for that particular company. So for example, like a discounted cash flow method, you enter your assumptions based on your own research, and then from there you're able to get a pretty good idea of how much the company is worth. After that, you compare that value with the current stock price of the company, and then you can see whether or not the company is undervalued or overvalued. We have many videos on our channel that are dedicated to the topic of valuation, so be sure to check those out if you want to get better at this particular skill. And keep in mind that valuation is not an exact science. What you want to do is to be approximately right as opposed to precisely wrong. So what really you're looking for is to make sure that the price is way lower than the current value of the company. So some people recommend maybe 20-30% lower, so that way even if your number is wrong, you're still off safe and you can still make a return on your investment. Now you know all the different steps to analyze a company properly. If you want to see this information in action, check out the video that we have on amplitude stock analysis. This video is very powerful because it walks you through this process for a very specific stock so you can see it practically step by step. If you've enjoyed this video, make sure to subscribe and turn on the notifications on, and I'll see you in the next one.